Welcome back, everyone. I am JM, and today I'm diving into a topic that might sound a little counterintuitive at first: why I love a stock market crash. Yes, you heard that right. While most people panic and run for the hills when the market tumbles, I see something very different. I see opportunity, and not just vague opportunity, real, mathematically grounded, psychologically sound opportunity that can supercharge your wealth over the long haul. I've been in real estate, fund management, and advising high net worth clients for over 30 years, and I want to share with you the exact framework I use to turn market downturns into wealth building machines. I call it the crash opportunity formula. Stick with me because this is going to change the way you think about market crashes forever. Section 1. The psychological trap of market crashes. First, let's talk about psychology. Market crashes trigger something primal in us: fear. It's wired into our DNA to avoid loss. Loss aversion is a well-documented psychological bias. Studies show that the pain of losing $1,000 is roughly twice as powerful as the pleasure of gaining $1,000. So when markets tank 20%, 30%, or even 50%, most investors feel paralyzed. This paralysis leads to bad decisions. Selling low, locking in losses, and then sitting on the sidelines watching the market recover without you. It's the classic mistake. But here's the contrarian truth. The market crash is when everyone else is scared. Your emotional brain is screaming, sell, and your logical brain is telling you to do the opposite, to buy. Why? Because the market is a discount store during crashes. The prices of fundamentally solid companies are slashed, and if you can separate noise from value, you can buy assets at a fraction of their true worth. Section 2, the crash opportunity formula, breaking it down. So what is the crash opportunity formula? At its core, it's a simple equation. Opportunity equals market decline percent times quality of asset times time horizon. Let me explain each component. First, market decline percent. This is the percentage drop from peak to trough. For example, during the 2008 financial crisis, the S&P 500 dropped roughly 57% from its peak in October 2007 to its trough in March 2009. That's a 57% discount on blue chip stocks. Second, quality of asset. This is critical. Not every bargain is worth buying. You need to focus on high quality assets with strong balance sheets, sustainable earnings, competitive moats, and proven management. Third, time horizon. This is how long you're willing to hold your investment. The longer your time horizon, the more you can ride out volatility and benefit from compounding growth. Putting it all together, if you buy a high-quality asset at a 50% discount and hold it for 10 years, your potential returns are dramatically amplified compared to buying at peak prices. Let's be clear, this isn't speculation or gambling. It's disciplined investing grounded in valuation, quality, and patience. Numbers don't lie. Let me give you some real-world context. Take the 2008 crash again. If you invested $100,000 in the S&P 500 at its peak in October 2007, your investment would have dropped to about $43,000 by March 2009, a 57% loss. Most people would feel devastated and sell out, but if you held on, by March 2019, your investment would have grown to roughly $340,000. That's nearly a 7.9 times gain from the trough over 10 years. The crash was a painful pit stop, but the recovery was a rocket ride. Now imagine if you had the courage to buy more shares during that crash at those depressed prices. Your gains would have been even more substantial. For example, an additional $50,000 in early 2009 would have grown to about $170,000 10 years later. Section 4. The deep psychological breakdown. Why most investors fail. Understanding the numbers is easy. Executing this strategy is hard because of human nature. Fear and greed are the twin forces driving investor behavior. When markets rise, greed pushes us to buy more and chase prices. When markets fall, fear paralyzes us or causes panic selling. Behavioral finance studies show that average investors tend to buy high and sell low, the exact opposite of what the crash opportunity formula requires. When the market crashes, your friends, family, and the media are all screaming sell. But the savvy investor leans in asking, what's on sale today? Section 5. How to implement the crash opportunity formula, step by step. So how do you put this into practice? Step 1. Prepare before the crash. You can't predict crashes, but you can prepare. Build a diversified portfolio and maintain liquidity so you have dry powder to deploy. Step 2. Monitor valuations. Use metrics like price to earnings and free cash flow yields to identify when assets are trading at a discount. Step 3. Develop a buying plan. Define the thresholds at which you will buy more. If a stock falls 30% below purchase price but fundamentals are intact, that's an opportunity. Step 4. Stick to your time horizon. Commit to holding for the long term, ideally 5 to 10 years. This smooths out volatility and maximizes compounding. Step 5. Automate and systematize. Set up automatic investments to avoid emotional decision making. Consistency beats timing every single time. Section 6. The Robo-Advisor Advantage, making the formula work for you. Now, I want to talk about how technology can help you apply this formula. Robo-advisors remove emotion from investing. They execute the crash opportunity formula systematically, buying undervalued assets during downturns. Many robo-advisors also offer tax loss harvesting, which can enhance after-tax returns during volatile markets. It's a game changer for busy professionals. To wrap up this first deep dive, reframe how you think about crashes. They are not disasters. They are rare, powerful opportunities to build lasting wealth. Section 7. Advanced strategies to amplify the crash opportunity formula. Let's explore how sophisticated investors amplify returns. 1. Dollar cost averaging with tactical adjustments. If the market declines 20%, consider doubling your investment. At 30%, triple it. This leverages volatility to accelerate accumulation. 2. Using put options for hedging and entry points. Selling put options allows you to generate income while acquiring assets at a discount. It's a powerful tool for downturns. 3. Sector rotation and thematic investing. Some sectors rebound faster. During the COVID crash, tech stocks led the recovery. Analyze economic cycles to rotate tactically. 4. Incorporating alternative assets. Real estate, private equity, and commodities like gold offer stability and inflation protection when stocks and bonds correlate. Section 8. Real-world case studies. To truly grasp the power of the formula, let's analyze past winners. Case Study 1. Warren Buffett and the 2008 crisis. Buffett deployed billions into Goldman Sachs at deep discounts. His patience and discipline generated massive returns. Case Study 2. The dot-com bust. Amazon stock fell 95% from its peak, but those who bought the dip and held saw extraordinary gains over 2 decades. Case Study 3. The COVID-19 crash. While many panicked, younger investors used the sharp drop as an entry point, reinforcing the need for psychological resilience. Section 9. The neuroscience of investing, rewiring your brain for market crashes. Neuroscience provides insights into why crashes trigger such strong emotional responses. The amygdala, responsible for fear, becomes hyperactive during crashes, often overriding the prefrontal cortex, which governs rational decision-making. You must train your brain to respond differently. Section 10. Behavioral finance tools, leveraging biases to your advantage. Biases are not just obstacles. They can be leveraged strategically. 1. Anchoring bias. Investors often anchor to previous high prices. By consciously de-anchoring and evaluating based on intrinsic value, you identify genuine bargains. 2. Loss aversion. Frame decisions in terms of gains. Think, I'm buying quality assets at 50% off, instead of, I'm risking losing money. Shift your mindset. Section 11. The role of macroeconomic indicators in timing crash opportunities. Macro indicators help refine your application of the formula. Watch interest rates, inflation data, and unemployment. An inverted yield curve is a reliable recession predictor. Combine these with valuation metrics for a nuanced approach. Section 12. The importance of tax efficiency in crash investing. Strategic tax management can significantly enhance your net returns. Use tax loss harvesting to offset gains and respect holding periods to qualify for long-term treatment. Ensure your gains are not eroded by avoidable taxes. Section 13. Building a resilient wealth mindset for market crashes. Cultivate a mental framework that embraces volatility as a friend, not a foe. Patience is key. Wealth accumulation is a marathon, not a sprint. Recognize that downturns are necessary for healthy market cycles. Trust your process. As we conclude, I want to leave you with a powerful perspective. Market crashes are the cornerstones upon which enduring wealth is built. The psychology of wealth retention is critical. Don't fall for the arrival fallacy, the belief that net worth solves internal problems. Wealth only amplifies who you are. Avoid the golden handcuffs. Don't upgrade your lifestyle just because society expects it. Decouple your self-worth from your net worth and your lifestyle from your income. Finally, talk about legacy. True legacy is the financial education you pass down, the values and principles of wealth building. Teach the next generation the math of compounding. Every video is built around a formula. Today's is simple. Wealth equals assets minus liabilities multiplied by time. This is the architecture of freedom. Whatever your version of freedom looks like, the path runs through these principles. Acquire assets, use leverage, trust the math. I'm JM. I'll see you in the next video.